Good morning and welcome to the Killik and Co Market Update. Last week we briefly talked about some of the key takeaways from the UK's mini budget which had just come out, but since then there's been a pretty sizable international backlash against it. The key concern is that the UK government has announced some major tax cuts without saying how those are going to be funded, and that has led to concern that the UK will be taking on lots of additional debt at a time when interest rates are starting to rise. Following the mini-budget, the IMF published a statement publicly disagreeing with what the UK has done. The statement said, "We understand that the sizable fiscal package announced aims at helping families and businesses to deal with the energy shock and at boosting growth via tax cuts and supply measures. However, given elevated inflation pressures in many countries, including the UK, we do not recommend large and untargeted fiscal packages at this juncture, as it's important that fiscal policy does not work at cross purposes to monetary policy. Furthermore, the nature of the UK measures will likely increase inequality." Following this statement from the IMF, investors have been selling off UK assets, including UK stocks, UK bonds and sterling. Over the weekend, sterling fell to a record low of 1.03 against the dollar. Mark Carney, the former governor of the Bank of England, has also been critical of the mini-budget, and he echoed the IMF's comments about fiscal policy not working at odds with monetary policy. And what he means by that is that the government is cutting taxes to try and boost economic growth. However, cutting taxes and giving people more to spend can be inflationary, and furthermore, the fall in the value of sterling means that our imports will become more expensive, and that's likely to push up inflation as well. That puts the Bank of England in a difficult position. They need to get inflation under control and they need to prop up the value of sterling, and the way to do that is by raising interest rates. However, raising interest rates are likely to slow economic growth, and that is exactly the opposite of what the government has been trying to achieve. The mini-budget has also led to some big falls in the prices of UK government bonds, also known as gilts, and the Bank of England has had to step in and buy these bonds to prop up the prices. And so far the bank has committed to buying £65 billion worth of UK government bonds. To understand this in more detail, let's remind ourselves how bonds work. A bond is a way of lending money to a company or a government in return for a fixed annual interest payment. Bond interest payments are known as coupons. So let's use this example of a 5-year bond with a 5% coupon. In year 0, you buy the bond for £100. At the end of year 1, you get the first interest payment of £5. In year 2, you get another £5, and so on and so on. And at the end of year 5, you get the final £5 plus the return of the original £100. Bonds are tradable and can change hands before their maturity date, and they can change hands at prices above or below £100. Above £100, that £5 per year will equate to annual interest of less than 5%. At less than £100, that £5 per year will equate to more than 5%. If interest rates are expected to rise, £5 per year starts to look less attractive, and this bond will start to fall in price. If inflation is high, then the future £5 look less attractive and the bond will start to fall in price. Long-dated bonds tend to be more sensitive, therefore, to changes in interest rates and inflation. So here on this chart, we've got the percentage changes in the prices of 3 different government bonds, and this chart shows the percentage changes over the last 2 years. The green one is quite short-dated and matures in 2023, and you can see the price has only come down a little bit. The purple one matures in 2027, and you can see the price is down by more than 20%. The pink one doesn't mature until 2060, and you can see this one has been incredibly volatile, and the price has cratered. You can see the price dropped further after the mini-budget, and it did recover somewhat after the Bank of England said it would step in and buy some bonds. A lot of UK pension schemes are required to hold these long-dated government bonds to cover their long-term liabilities, and they will certainly be relieved that the Bank of England has stepped in to support the prices of these assets. And finally this week, Hurricane Ian has made landfall in the US and is expected to cause up to $67 billion worth of damage. And to put that into context, here on this chart we've got the costs of some other natural disasters in prices of 2021. So for example, you've got Hurricane Katrina there, which cost $167 billion. Experts believe that these weather-related natural disasters are becoming more frequent and worse because of climate change, and this really supports the view for investing in renewable power. Moving on to have a look at next week, it's looking pretty quiet on the calendar. We've only got Tesco due to report next week, but the following week we move into the third quarter reporting season, and it should start to get much busier on the calendar from then. That's it from us. Enjoy the weekend, and we'll see you next Friday.